back with another stock analysis. Today we'll be looking at Sensus Healthcare, or SRTS. So I don't know anything about this company. Obviously, they are a healthcare company. They are actually on the larger side at around a $95 billion valuation. So definitely a fairly large company. So we're going to get into them, look at their financials, go over their chart, do a little bit of evaluation, and we'll see what the company looks like. So if you're interested, make sure to subscribe. I make these videos just about every day of the week. And let's get into Sensus Healthcare. So getting into Sensus Healthcare, they are a medical device company for treatment of skin conditions. So super fascinating there. Yeah. But anyway, market cap is sitting at, oh, wow, I was so wrong. This is a $95 million company, and it is actually very, very small. So completely disregard what I said in the intro there. $95 million company. Let's retrace the steps there. But anyway, target price is at $13 a share currently, which I believe we are at $5.76 right now. So a decent amount of upside there. There was very recently, if you look here, a fairly significant drop over the past 2 months where they were at right around $8 a share. And actually, we can look right now and see where their stock price is. So in their last earnings report, they got hammered. Despite rising a ton a couple of days before and on the day of the report, which I believe, okay, the report was at night, so that does make sense. Dropping over 30% and then dropping again the next 2 following days, including today, is not great. Clearly, the report was not very good. However, if we just look at the company overall, we could see it is fairly mixed. Clearly, they have entered a downtrend. Now they broke through a lot of support over the past 2 weeks, which is not great. I think if this earnings report went well, we would have seen the stock price probably reach back up to this $13 to $15 range very quickly. But unfortunately, that did not happen. And now we might see it go down, honestly, back to like $3 to $4, just based on this sort of 30-second estimate here. But anyway, not getting into that just yet, even though I already did. Let's keep moving on here. So one thing I will say is that EPS are positive, although mostly very slightly positive, but they are positive, which is not something you see for most companies or for some companies. One thing, though, which I am just seeing now, the growth summary is very mixed. And honestly, even the long-term numbers aren't that crazy. Positive free cash flow over 10 years is good. And sales is too, but sales is mixed overall. And 8.8% growth over 10 years isn't that crazy, especially for just sales. Now, overall, it does not look great. Also, their 1-year estimates here are horrible. They're expecting to lose 98% of their net income, which just seems unprecedented if that does happen. But anyway, let's get into the financial statements and see what's happening here. So first off, we will go into the years and see what we're dealing with. So they have seen, honestly, a ton of sales growth over the past just about 4 years. However, you can see it is a bit shaky. So they have actually been right around plus or minus 10 or so million from 20 million, basically their entire past 10 years. And just recently in the past 3 years, they broke over 40 million. And now they're seeing that again in 2024 as well. This is preliminary results, however, so just something to keep note of. Net income has been positive for the past 4 years. So although their sales have been roughly in the same ballpark, for the most part, other than 2024 and 2022, they have become more profitable, which is good. That's a positive sign. Clearly, 2022 was by far better than 2024, though, because their profitability is nowhere near where it was 2 years ago, where their profits were at 24 million, and right now they're at 6.6 million. So something very clearly happened there that killed their profitability, or possibly they're just focusing on trying to sustain growth. Hopefully that's what's happening. Other than that, total shares have been, looks like, increases, but over the past few years, not as much. And actually, they're down slightly. So really nothing to say for the total shares here. No major changes really at all. Going into the balance sheet now, let's see what we're dealing with. So total assets have been increasing, and a lot more consistently, at least, than the sales have been or the income statement has been. So that is good. 62 million in total assets, $95 million valuation for the company. So that's fairly good. They do have a lot more assets than they used to, though. And in 2022, they had 6 million less in assets, but made 18 million more in profit. So there's probably something not great that's been happening with buying these assets where they are not really helping with the profitability. Or again, they're just focusing on scaling and growth of the company right now and not really bothering with profitability just yet. That is another possibility to consider, just to be clear, but still could be a bit of a problem where they're buying up more assets over the past 2 years, but they are losing profitability. So just something to consider. For their cash situation, they have 22 million and basically no debt, which we've been seeing a couple companies like this recently where they have a ton of cash and very little debt. And I always say this is a very good sign for a company where they have no debt and a lot of cash. They can use that for so many different things now, either just cash flowing themselves for the next few years, which this company doesn't need because they are in fact profitable. But for some other companies we looked at, that is a very good thing where they don't have debt but a ton of cash. For this company, they could use that for acquisitions. They could use it, like we said earlier, to increase their assets further. So it's really just opens a world of opportunities when you don't really have that much debt at all, like Sensus does here. So overall, looks very good. Other than that, let's move into the cash flows now and see what's going on. So we do not have full year 2024 data here yet. So let's go into the quarters for their cash flows. So overall, fairly mixed. You could see recently they have had a couple quarters with some bigger positive cash flows. I'm assuming that's probably what they had in 2022 as well, which we can see if we just zoom out here a little bit to the past 15 quarters. So 2022, they did have a couple that were above 3 million. It looks like they just had a quarter above 4 million operating cash flow for the first time, and the September quarter came close to that as well. So there is some growth in their operating cash flow, which is good. Other than that, no real sales or even purchases of assets for the past 2 years until March 2022, where they sold about 15 million worth of assets. So really no crazy changes with this. Capital expenditures are also very low for the company, which is a little unusual, but still, I can't really say that's a bad thing because honestly, they're just spending less money. Other than that, very little changes in capital stock, especially over the past year and a half. Before that, it was a little bit mixed where they were buying and selling on and off, but other than that, nothing crazy. No issuance or reduction of debt in the past 2 years, other than a very small payment. So overall, great looking there. And free cash flow is primarily positive, which is good. However, the quarters where it was negative are much higher. So that is something to think of. I think if you added up all of the numbers here, it would be overall negative. So that is something to consider. But overall, it looks fairly good. They've definitely been seeing more positive free cash flow recently, which is always good to see. And now let's look into their ratios and see what's going on here. I'm probably going to have to, okay, they do have 2024 preliminary. So gross margin is below 5-year estimates, up from a year ago. SG&A to sales is by far lower than their 5-year average and much, much lower than a year ago as well, which is good, very positive. Same thing with net margin, much higher than their average and much higher than a year ago. You could see 2022 is really just a massive outlier year for them where they massively outperformed almost every single metric, which is fantastic for the company, but overall they just couldn't sustain it through 2023. And now it looks like they're kind of getting back to where those really, really solid numbers were. Net margin being that much higher is awesome. That's great. Return on assets and equity is also much higher than the year prior, although slightly below the 5-year averages, but overall that's fine. So really year over year, we're seeing a ton of improvement with the company. Debt to equity looks perfectly fine, below 1% or at 1%. So no issues there at all. And now let's get into an earnings report and see if we could see. We'll see what they have here. Oh, they do actually have. Now, why is this for Plug Power? Let me refresh this. I was looking up Plug Power earlier, so sometimes it likes to get a little messed up here for me. And it looks like it'll fix itself possibly. There we go. Okay. So, of course, we do not have street takeaways now, but that is okay. Let's look into these results and see what we're dealing with. So, highlights include the following. We'll read through this. Revenues were 13.1 million for the quarter and up 4% quarter over quarter and 71% for the year, which is awesome. Net income was the fifth consecutive quarter of profitability, which again is very good. Quarterly record of systems they shipped, which is awesome, up 18% and 74% for the year. Again, very, very good here. Overall, I think this looks very well. Ended the year with no debt and 22.1 million in cash. So that is fantastic. Signed additional fair deal agreement revenue sharing programs and expanded interest among customers with multiple new agreements in the pipeline for 2025. So they do have plans to increase their revenue going into 2025. I would love to see the guidance if they have any. I'm not going to read through every single thing here because that's mostly just what we've already seen. Let's see if there's any guidance in this. That is kind of what I'm interested in. Not seeing anything right now. Let's go back. I believe this is just metrics, and yeah, that is just metrics. So I don't think there's any guidance here, unfortunately. There would be the earnings report transcript, which I'm sure they have guidance in. I do not want to read. Oh, here we go. Near term guidance summary. Fair deal agreement contributions to top line in the second half of 2025. They're resubmitting an application for, I'm assuming, one of their products to get approved for use, which is good. Continued momentum, lower quarter one 2025 compared to quarter one 2024. So first quarter, they're expecting lower sales, but overall, they're expecting to be growing in sales for the fiscal year. Overall, fair deal agreements expected to drive revenue, deepen ties with large medical practices, and expand international footprint. So overall, there's really nothing specific here, unfortunately, which it seems like there just isn't at all. So there's no specific numbers, which kind of makes sense considering how small of a company this is. They really don't have massive institutional shareholders that they need to answer to about why they aren't increasing their guidance every quarter. So I kind of understand that, but overall, I would have liked to see a little bit more other than just we think our sales will go up. So other than that, I think we're basically done here. Now, I can try to go into a valuation. However, just based on how small the company is, I don't think there will be really any information here, which if we look named competitors, there is one named competitor here. So not great there. And they don't even have a PE ratio to go off of. We could try their subsector or their industry group, but overall, I don't think we're going to get too much information. If it even loads for me here, which sometimes it likes to struggle. So, okay, we are getting a couple different companies now. And of course, none of them have their PE ratios available. So I think I'm going to have to call it here. And yeah, most of the companies that they're related to are also very, very small. So it kind of makes sense that there isn't too much stuff to go off of here. And yeah, there really isn't. So that's all I got for Sensus Healthcare today. Definitely an interesting company. I think we're going to see their stock price falling a decent amount more. However, this earnings report honestly was fairly good in my opinion. But just based on the way the chart looks, they broke a decent low right here, and it looks like they're going to be continuing to drop lower. Now, they could be finding some support fairly soon, which honestly wouldn't shock me only because the way that the stock has been looking, I think there is a decent amount of upside here. I honestly thought that earnings report was really solid. That seemed like they had a lot of great things going on. Obviously, fairly weak guidance. There's really nothing to say for the guidance there at all, which is always kind of a concern. Another thing you can say is there is a support level here, which they're sort of in, depending on how you want to draw the line. But overall, they're kind of right on the support line. However, they're basically right on the edge of it right now. So something to pay attention to. I think if they break below the support line further, it's going to continue dropping, possibly to the $3 to $4 range. Wouldn't really shock me, but overall, that's all I have now for Sensus Healthcare. So thank you so much for watching. Make sure to subscribe if you haven't, and I will see everybody in the next video.